An IPO, or an initial public offering, is the first time a company issues shares to the public. This is when a private company decides to go public. In other words, a company that was privately owned until then becomes a publicly traded company. Before the IPO, a company has very few shareholders. This includes the founders, angel investors, and the venture capitalists. But during an IPO, the company opens its share for the public. And as an investor, you can buy shares directly from the company and become a shareholder. There are three different categories when it comes to IPOs. These include qualified institutional buyers, non-institutional investors, and the retail individual investors. The allocation of shares differs for all the above groups in an IPO. And as an individual investor, we come into the last category. As an individual investor, we can invest in small lots of 10 to 15,000 in an IPO, and you can apply for a maximum rupees 2 lakh in a single IPO. The total demand for shares in the retail category is judged by the number of applications received. If the demand is less than or equal to the number of shares in the retail category, you are offered a full allotment of shares. While if the demand is greater than the allocation, it is known as oversubscription of an IPO. Many times, an IPO can be oversubscribed 5 to 6 times over. This means that the demand for share exceeds the supply by 5 to 6 times. In such cases, the shares in retail category are offered to investors on the basis of a lottery system. This is a computerized process that ensures impartial allocation of shares to the investors. But why does a company want to go public? This is basically done to raise capital for growth and expansion, as every company needs money to increase its operations, create new products, or pay off existing debts. Going public is a great way to gain this much money for a company. And it also allows owners and early investors to sell their stake to make money. It is often seen as an exit strategy for initial investors and venture capitalists. A company becomes liquid through the sale of stocks in an IPO, and venture capitalists sell their stocks in the company at this time to reap returns and finally take exit from the company.